Jason Katz is with us this morning to cover the markets. Okay. Headline in the Wall Street Journal: Americans are really, really bullish on stocks. Not this morning, apparently. I would have thought maybe that makes us, the rally continues, but apparently not.
What hasn't been, there's been a good reason to be bullish, right? We've had uninterrupted rise over the course of the last 2 years, with the exception of 2 weeks ago where we had a little bit of a dip. Frankly, it's been the institutional investor that's been driving this market, because from a standpoint of cash, we saw $106 billion go into money markets last month. So, yeah, we have an economy that's heading towards a soft landing. We have the Fed on the precipice of cutting rates. All of that's constructive for equities, but we're not without our risks.
Okay. And what are the risks?
Well, number one is that this landing is not soft. This is a tough needle to thread. So, as evidenced by what you said with the prices paid, we're in a paradigm where bad news is now bad news. The Fed comes in with a 0.5 point cut. That would be construed as a sign of panic, and the markets could take a leg down.
Okay. I read your stuff, and you say that there is a big problem for the economy and the markets with this plan to tax unrealized capital gains, the so-called wealth tax. What's the big problem?
I mean, that would be an unmitigated disaster. Now, granted, they're talking about this for only those that have over $100 million net worth. But as I was talking about with Steve Forbes offset, they start with that, but then it infiltrates other parts of the tax system. But here's the deal, right? If you have an ultra high net worth person who bought, say, $100 million worth of Amazon, and it goes to $150 million, and they tax 23% on that $50 million in year one, if in year two that 150, because Amazon drops, goes back to 100 million, is the government going to rebate the tax from the previous year? It'd be an accounting nightmare, not to mention the fact it would suck money out of the capital markets. Plus, this applies to real estate. Are real estate owners going to liquidate real estate to pay for taxes? It makes no sense whatsoever.
Quick point, though. There's a lot of cash out there. I believe it totals, what is it, $6.24 trillion. Have I got the number right? Because that's an enormous amount of money.
It is indeed. And as I said earlier, 100 billion more was added to that pile just last month alone. So as the Fed starts cutting rates, I'm always asked, is that going to go all back into the market? Some of it for sure will. And it'll go into the cyclical parts of the market, the parts of the market that have been left behind. I've said on this show countless times for months on end that the money is going to be made in equal weight, in small cap, in mid cap. So this rotation trade is in its early innings. We may not get the gains from what brought us to the party. That's not what's going to take us home. It's the other constituents. Assuming a soft landing, that'll be where investors make their money.
Jason, thank you very much for joining us. Appreciate it.